Let's talk
Thanks,
about
David.
this relatively risk-on week we saw this week. What do you make of it, given the fact that we are at war?
Well, the Fed's trying to create a Goldilocks scenario by engineering a soft landing. The equity markets are buying it and the bond markets aren't. We're watching three key things to monitor whether we're going to get to that, and that is the Fed movements, inflation, and geopolitical issues. The equity markets like what the Fed said in terms of becoming more hawkish because they're catching up to what's going on with inflation, getting more credibility around that battle. The equity markets like it because it means we won't have runaway inflation. Now, when it comes to inflation, the key question is, can economic growth be strong enough to overcome inflation? We think it can. Geopolitical risks are here to stay. With Russia, though, we see overall impact on global growth as moderate, but areas that we're monitoring are financial channels, commodities, and the impact on the European Union. All of that together still leaves us moderately bullish for the year.
So Saira says the effect on the markets will be relatively moderate from the war. The war is not going the way we thought it would. We thought it would over quickly one way or the other. It isn't. Are you more concerned about long-term consequences?
Yeah, exactly, David. Saira, I would have to say, I think the markets actually have their heads stuck in the sand. The bond market, they're awake and they're paying attention. I mean, David, as you said, twos are back to 228. There's a 30 basis point spread between twos and 30s. That tells me the 30-year bond knows it's going to be a flight to quality because it's a safe haven in a war, which is the word you started with this. Equity markets shouldn't be rising. They go up at the beginning of inflation. And Saira, I give you that. But I think long term, the bond market's got this right and the stock market's got this wrong. It should be more cautionary and it should be more worried about inflation long term.
Well, it's interesting, Chris, because if you look at the yield curve, actually it's the front end of the yield curve, if you look at history, that is a strong indicator of recession. It's at some of the steepest levels that we've seen in almost a decade. So while I agree with your points, I think one thing is important is a yield curve can tell you a recession's coming, but the timing is crucial. A lot of money can be left on the table during the early cycles of rate hikes and initial yield curve inversions. Markets tend to be quite strong. And what my concern would be, you might leave a lot of money on the table if you become too concerned at this point about a future recession.
So, Chris, as you manage that really substantial portfolio out there at CalSTRS, what do you look at in the yield curve, if anything at all? We heard from Jay Powell this week, and he said, look, sure, we pay attention to everything, but it's really the very, very early part of the yield curve which we focus on, not, for example, the twos, tens.
Jay can't control the twos, tens. He can talk it up and he can jawbone it. You guys have a wonderful montage of a whole bunch of Fed governors who all talk about the next meeting that not only is 50 basis points not off the table, I think one of them at the end says could be 0, it could be 25, could be 50, could be a point. I just think we have to recognize we're in a rising rate environment. Sarah's right. At the beginning, stocks do quite well at the beginning of inflation period, but this is not going to go away. This isn't, remember, transitory? It's not transitory. Inflation's going to be around. And this war impact is going to be felt, not just in the wheat market, but due to the lack of fertilizer. I really think, and I know Larry Summers will talk to you later, that we're going to run into risk of a global famine, at least certainly in Europe when it comes into the summer and fall. So, Saira, I like stocks in the middle market, but I'm worried long term that we need to be more balanced in all of our portfolios.
And Saira, what about the inflation picture? Because I have heard talk of the fact that the deflationary pressures are basically gone between the supply chain and some of what we're seeing. The excess capacity is used up, and we're going to have inflation for a good long time to come.
I mean, if you look at the estimates for inflation and the break-evens, we're seeing about 4% inflation over the next couple of years, and then even 2+% over the next decade. So you're right in that higher inflation is here to stay. The question is, what does that lead to? We're not in the stagflation camp. The recipe really isn't in place for that because we have strong economic growth and strong employment to go along with that inflation. So the key is, can the Fed raise rates enough to keep inflation with a lid on it while also letting economic growth continue? We think that is a likely scenario that can happen. Initially, the Fed will raise interest rates pretty aggressively. Markets are expecting about 40 basis points of hikes in the next two meetings. So that's kind of hedging their bets between 25 and 50. We're in the multiple 25 basis point rate hikes for the next number of meetings. But then the Fed can wait and see. And if inflation does start to level off, they can also back off a little bit. And that would be that soft landing that they're trying to achieve.
Sarah, I've got to ask you because I'm baffled about this, so I want your opinion. The unemployment numbers this week were staggeringly low. The number of new jobless claims. We're having a hard time finding people. Yet I know there are tons of people out of work. I mean, what do you guys make of this job market? Is it super strong, or are we going to see a backlash of higher wages, which compounds the inflation problem?
I mean, I have to agree with you. The job market has been, the issue has been on the supply side. How do you get people back into the workforce, and what does it take? It's been an issue going on for months, and question, because wage inflation is a big component of overall inflation. How much wage inflation will there be necessary to bring people back in? We expect the job market to loosen up a bit going forward this year, now that we're past the most recent COVID variant. But when we're looking at our portfolios, the one key is, and why we do like equities from here, is focus on those companies that have pricing power. So if you have the pricing power to overcome inflation, expand your margins, beat earnings, and also economic resilience, we like US large cap growth stocks for that reason. I think you can succeed in this kind of environment where growth does slow, but not to recessionary levels.
I'm going to give you a hint, just some feedback, because we talked to a lot of teachers in California, and companies actually are not going to have a lot of pricing power. I mean, they are squeezed. As you know, in California, gas prices are north of $6 a gallon. And now that everybody is supposed to start driving back to work in the month of April, they're going to feel that squeeze in their pocketbook. So lucky companies that might have some pricing power, but I think, as we've seen, they're reducing the size of their servings and their products. And I think people are going to get squeezed. I think this inflation is going to catch them off guard. And I think, David, as long as we see this war continuing, you're going to have inflation pressures built into this economy, which the Fed is going to have a hard time beating, because it's price inflation and potentially wage inflation.
Chris, I want to take advantage of you here because you're such a major player in the institutional market here. We saw last year in the proxy combat, certain issues come up, things like how we treat workers and diversity and climate. Are those going to be the issues this year, or is it going to be a new world given what we're seeing with inflation, given what we're seeing going on with the war?
It's going to be those issues, and even turned up on high. It's going to be, if you think of it, while people take those politically, to us, they're risks to a company, long-term risk. If their workforce isn't diverse, they're going to suffer from the lack of different people thinking in different ways. If they're not thinking about climate change, they're behind the curve and they're going to have to pay a price. So for us, those are long-term risks. And I think supply chain is going to be a big question to people about their risk. People care more about human rights now that they realize how important Russia was to places like Germany. What about human rights in China? And you're going to see more and more companies need to address those and report to shareholders and give us information. But there's no question that diversity, inclusion, and then the race to net zero are absolute priorities this year and next year and the year after.
Saira Malik.
I agree with.
I'm sorry. Go ahead, Sarah, please.
Thanks. No, I was going to say, I agree with Chris. Globalization, climate change, and diversity inclusion, three key issues going forward in a world that is constantly changing.